The internet kind of lost its mind over the SpaceX IPO. A lot of people are convinced it's about to land in their retirement savings and quietly drag down the ETFs they're counting on for their pension. So we're going to go through what's really happening here. And by the end, you'll know how much of a $10,000 portfolio actually ends up in SpaceX under the rules as they stand today. Two quick disclaimers first. None of this is investment advice, and this story keeps moving. Some of these numbers and rules changed even while the video was being made, so treat all of it as a snapshot. Here's the situation. SpaceX is going public at a valuation of around $1.8 trillion, which would instantly make it one of the 10 most valuable companies in the world. And it isn't the only one. OpenAI and Anthropic are both expected to follow later this year, so three of the biggest companies on the planet could hit the market within months of each other. SpaceX is expected to start trading on June 12th on the Nasdaq. The other two haven't even filed their paperwork yet, so they're looking at later in the year. The worry is understandable. People think these are bubble-level valuations, wildly overhyped, and that once they're dropped into the big index funds, everyone holding a boring world ETF is suddenly exposed to them. There's also a more specific accusation going around, that the index providers quietly rewrote their own rules to let SpaceX in early, almost as a favor to Elon Musk. And the awkward part is that a lot of this is genuinely true. The valuation really is enormous, and some of the rules really did change. But whether any of that actually reaches your retirement is a completely separate question. So let's work it out properly. The first thing to understand is what's even being sold here, because SpaceX isn't putting the whole company on the market. They're only floating about 5% of it. The other 95% stays privately held, mostly by Musk, who also keeps roughly 85% of the voting power. That 5% that does get traded has a name, the free float. It's simply the share of a company that's actually available to buy and sell. And that one idea is the key to this whole video. Even at 5%, the amount of money is staggering. SpaceX wants to raise at least $75 billion, which would make this the largest IPO that has ever happened. So why does the free float matter so much? Because most of the big index funds don't weigh a company by what it's theoretically worth. They weigh it by how much of it is actually floating. Which means that scary 1.8 trillion headline isn't really the number that affects you. The number that matters is that small 5% slice, and different funds treat it in very different ways. So let's go through the 4 funds people are most likely to actually own, one at a time, and see exactly what each one does. We'll start with the MSCI World, which is probably the single most popular retirement ETF in Europe. It holds around 1,400 large companies from right across the developed world. It weights every company by its free float, and it has a waiting period built in. A new stock normally has to be listed for about 3 months before it's added, and the fund reshuffles every quarter. It also normally wants at least 15% of a company to be floating, and SpaceX only has 5. But there's a fast-track exception for genuinely huge companies, and it lets SpaceX skip most of that wait and join within the first couple of weeks. So when you actually run the numbers, how much SpaceX ends up inside your MSCI World? Roughly 0.1% of the entire fund. In real money, that's about $11 out of a $10,000 portfolio. That is the entire exposure everyone has been panicking about. Next is the FTSE All-World. It's the same basic idea as the MSCI World, but it also includes emerging markets, so it's broader still. If you own Vanguard's popular All-World fund, this is the index behind it. It also weights by free float, but it's the most relaxed of the group. There's no waiting period at all, and it only asks for a 5% float, which is exactly what SpaceX has. So the result comes out almost identical to the MSCI World, around 0.1%. Once again, about $11 out of every 10,000. The S&P 500 is a different story. It's the giant for American investors, the 500 largest US companies, and the default retirement fund for a huge part of the country. It also weights by free float, but it's strict about who gets in. You need 12 months of listing, at least 10% floating, and this is the important one, you actually have to be profitable. There was a real push to loosen all of that for SpaceX. They discussed cutting the waiting time to 6 months and adding an exception for mega-caps, but in the end, those changes were rejected. And here's what really settles it. SpaceX is still losing money, somewhere around $5 billion last year, so it fails the profitability test anyway. So for the time being, the S&P 500 simply isn't including it. If the only thing you own is an S&P fund, your SpaceX exposure right now is basically zero. And finally, the Nasdaq 100, the tech-heavy one. The 100 biggest non-financial companies on the Nasdaq exchange. This is where the story gets genuinely interesting, because unlike the others, the Nasdaq 100 doesn't weight by free float at all. It weights companies by their full value. So instead of counting just the 5% that's trading, it would treat SpaceX as if the entire 1.8 trillion belongs in the index. That's a very different starting point. This is also the index that bent its own rules the most. It used to add new companies just once a year, every December. Now it does it every quarter. It used to require a 10% float, and that rule is simply gone. And it added a brand new fast track that could bring SpaceX in within about 15 trading days. To stop a barely floated company from getting a wildly oversized weighting, they added a cap. A company can now count for at most 3 times its float, so SpaceX's 5% gets treated as 15%. And even after all of that, the result is still pretty small, roughly 0.5% of the Nasdaq 100. That's about $50 out of 10,000. More than the others, but hardly the disaster people imagined. There's one thing genuinely worth flagging though. Because of that 3 times rule, every extra percent Musk decides to float forces the index to buy 3 times as much. So over time, he effectively sits on a demand switch for his own stock. That's a real thing to keep an eye on, even if today the weighting is tiny. And those other 2 giants, OpenAI and Anthropic, if they each go public at around 50 billion, they'd be even smaller, something like 0.06% in a world fund, a handful of dollars each. So the whole index panic mostly falls apart once you do the maths. But there's a second question people keep asking. Should you just buy SpaceX directly when it lists? And this time, you actually can. A broker like Trade Republic is letting ordinary investors subscribe to the IPO directly, at the offer price. That's pretty unusual. Normally you'd have to wait until it's already trading and buy whatever's left. The way it works is you say how much you'd like, and because these things get oversubscribed, you often only get a fraction. Ask for $300 worth and you might be handed a third, with the rest refunded. And with only 5% of the company actually floating, the price can be genuinely jumpy. When so few shares are trading, even fairly modest orders can move it sharply. On top of that, the history of IPOs really isn't pretty. The University of Florida has tracked more than 9,000 of them since the 1970s. The typical one is down around 26% 3 years later, and roughly 60% of them end up underwater. So the base rates here are working against you. The first day tends to be the fun part. The median IPO pops about 7%, and most of them close their opening day in the green. But there's a pattern worth knowing. The bigger the company, the smaller that first day jump usually is, because the market already understands it so well. And SpaceX would be the biggest IPO in history. So realistically, day one could go either way. It might rip higher, or it might sag under the weight of its own hype. If you do want a piece, only use money you're genuinely fine losing. And again, this isn't advice. It's also worth keeping the Elon Musk factor in mind. Tesla has been called overvalued for years, people keep betting against it, and it just stubbornly refuses to fall. SpaceX could easily behave the same way. Now, let's come back to that accusation, because it's the most interesting part of the whole thing. Why did some of these indices change their rules at all? The official answer is actually pretty reasonable. An index is meant to reflect the market, and it can't really do that if it permanently locks out the single biggest company on it. But Reuters reported something more telling. Getting into the Nasdaq 100 early was apparently one of Musk's conditions for choosing to list on the Nasdaq in the first place. And that makes sense once you remember that exchanges compete for listings. The Nasdaq and the New York Stock Exchange both want a company this size because it brings prestige, attention, and trading volume. So the rule changes weren't really about your index desperately needing SpaceX. They were partly a way to win the listing. And the guaranteed buying from index funds is a big part of what makes a company this size so worth fighting over. So, after all of that, should you actually be worried about the SpaceX IPO ruining your retirement? Realistically, the answer is no. If you hold a normal world index fund, we're talking about $10 or $11 out of every 10,000. Even in the tech-heavy Nasdaq 100, it's around 50. That simply isn't what decides whether your pension works out. There are fair things to criticize here, the sky-high valuation, the fact that Musk keeps nearly all the votes, and a float so thin that a handful of trades can swing the price. But none of that is a reason to tear up your whole strategy. If anything, the more useful question is how much of your world fund is already just the United States to begin with. That's genuinely worth thinking about. A rocket company sitting at 0.1% really isn't.